Hey everyone, welcome back to the channel. Today we're diving into one of the most powerful financial principles that can transform your wealth over time: compound interest. Now, you've probably heard the term compound interest thrown around a lot. It might sound complex or technical, but at its core, compound interest is actually pretty simple and super powerful. So powerful, in fact, that Albert Einstein is rumored to have called it the eighth wonder of the world. Whether or not that's true, compound interest really does hold the potential to make or break your financial future. So, what is compound interest exactly? Let's break it down. Compound interest is the interest you earn on your initial investment, plus any interest you've already earned. Think of it as interest on interest. It's a snowball effect. Over time, even small contributions can grow into a massive amount, thanks to compounding. In other words, it's not just the money you put in, but the money that grows on top of that, and the money that grows on top of that, and so on. But here's the thing. To truly harness the power of compound interest, you need one key ingredient: time. The earlier you start, the more powerful compounding becomes. And that's why starting early is so crucial. So, let's take a look at an example to see compound interest in action. Imagine two people, Alex and Jamie. Alex starts investing $200 a month at age 25. Jamie, on the other hand, starts investing the same $200, but they start 10 years later at age 35. Both invest until they're 65, and let's assume they earn an average annual return of 7% on their investments. By the time Alex turns 65, they've invested a total of $96,000. But with compound interest, that $96,000 has grown to about $525,000. Jamie, who started later, has invested a total of $72,000. But by the time Jamie reaches 65, their investment has only grown to about $245,000. Now, both invested regularly, both earned the same return, and both retired at the same age. But because Alex started 10 years earlier, they end up with more than twice as much as Jamie. So if you're young and thinking, "I'll start investing when I'm older," think again. Waiting even a few years could mean the difference of hundreds of thousands of dollars in retirement. And it doesn't just stop at retirement. Starting early also gives you more freedom to pursue dreams, take risks, and even retire early if that's your goal. Now let's go over some basic principles you can follow to take advantage of compound interest. First, start as soon as possible. You might think, "I'll wait until I have a better job," or "I'll start once I'm done with school." But the truth is, the earlier you start, the better. Even if it's only a small amount each month, you're building that foundation. Next, invest consistently. Whether you're investing a little or a lot, staying consistent is crucial. Regular, consistent investments build up over time and fuel that compounding effect. Another important tip is to reinvest your earnings. Compound interest works best when you let your returns grow. If you're earning dividends or interest, consider reinvesting those earnings to keep the compounding cycle going. And, of course, be patient. Compounding takes time. The first few years might feel slow, and you might be tempted to pull your money out. But the longer you wait, the more powerful compounding becomes. The real magic of compounding happens in the later years. That's when you see exponential growth. All right, let's take a quick look at another example. Imagine you start with just $1,000 and invest $100 a month at a 7% return. After 1 year, you've invested a total of $2,200. With compound interest, you're not just sitting at $2,200 though, you'll be at about $2,273. By year 5, you've invested a total of $7,000, but with compounding, you'll have around $8,500. Fast forward to year 10, and now you've invested $13,000 in total. But because of compound interest, your investment will have grown to over $17,000. 20 years down the line, you'll have invested a total of $25,000. But with compounding, your investment will have grown to over $52,000. And remember, this is just one example. Imagine if you had started with more or invested more each month, or if you earned a higher return over time. Compounding amplifies everything. But maybe you're thinking, I'm not 25, I'm already in my 30s or 40s, isn't it too late? Absolutely not. Starting today is better than starting tomorrow, no matter your age. Yes, time is a huge advantage, but the next best thing to having time is getting started right now. Every day you wait is another day you miss out on compounding's power. So, start now with what you can and be consistent. Now, some of you may be wondering, what's the best way to start investing? It all depends on your goals and risk tolerance. But here are a few general options to consider. One option is to invest in the stock market. Historically, the stock market has delivered higher returns than most other investments, averaging around 7 to 10% annually after inflation. But remember, stocks can be volatile, so it's important to stay focused on the long term. Another option is mutual funds, or exchange-traded funds, also known as ETFs. These are collections of stocks or bonds and can be a great way to diversify without having to pick individual stocks. Many ETFs follow indexes like the S&P 500, which represents a wide range of large U.S. companies. If you want to be a little more conservative, you could look into bonds. Bonds tend to be lower risk than stocks, but they also offer lower returns. They're a great way to balance out a portfolio. You might also consider contributing to a retirement account, like a 401k or an IRA, if you're in the U.S. These accounts have tax benefits that can boost your overall returns, and some employers even match your contributions. That's essentially free money added to your investment. Another idea is real estate. Real estate can be a powerful way to grow wealth and benefit from compounding, especially when values appreciate over time. While it requires more upfront capital and isn't as liquid as other investments, it can be a great addition to a diversified portfolio. And don't forget about dividends. Many companies pay dividends to shareholders. Reinvesting those dividends can lead to even faster growth over time, thanks to, you guessed it, compounding. Regardless of the method you choose, the key takeaway here is this: get started, stay consistent, and let compound interest do its thing. So why wait? Time is the most powerful ally you have when it comes to building wealth. By starting now, you're giving yourself the gift of time. And in the world of investing, time truly is money. Every day you wait to invest is a day you lose in potential growth. Think of compound interest as planting a tree. The best time to plant it was years ago, but the second best time is today. Start planting seeds of wealth today, and in the future, you'll thank yourself. Whether you're saving for retirement, a down payment on a house, or even your dream vacation, compound interest can help you get there faster. You just have to take that first step. All right, that's it for today. If you found this video helpful, don't forget to like, subscribe, and share it with a friend who could use a little motivation to start investing early. Let's make smart money moves together. Thank you so much for watching, and remember, the sooner you start, the more you'll gain. See you in the next video.